Hey, good morning. It's Mary Ellen McGonagle with the MEM Edge Show. And this is the show where we put you in front of stocks that are on the move. So let's go ahead and get started. We have a lot to cover today. Let's review the agenda. First, I'm going to go ahead and review where the strength currently is in the broader markets. And for those of you that have been watching this show each and every week, you know that that is a big part of what we are uncovering here. We want to know where the current strength is in the broader markets. Where are those money flows heading? And all with an eye toward getting you in front of not only stocks, but you need to pay attention to those industry groups that those stocks are a part of. So we're going to go ahead and uncover where the current strength is in the markets. And then also, we will begin with a very quick review of the broader markets. We need to stay on top of those markets. Are we in a position of strength? And if so, where again is that strength within that market? And then also, earnings season is still alive and well. It's not quite as robust as recent weeks, but we are going to go ahead and take a look at some earnings, what I call setups for this week. We're going to be looking at stocks that are due to report their earnings. And over my many years of studying the markets and looking and uncovering stocks that are poised to outperform the markets, I've reported this again and again. The fact that earnings are the primary driver for these big outperformers. So we want to pay attention to stocks that have reported. Are they coming in ahead of estimates and guiding higher going forward? This is all quite critical. But there also are clues going into earnings. I'm not a big fan of buying stocks ahead of earnings. You can, of course, see the volatility we've seen recently in stocks that even coming in ahead of estimates are getting damaged and hit. But we will take a look at some stocks that are setting up for positive outcomes with their earnings reports. And I'll share with you some of the clues, some of the key characteristics that point me toward these stocks as looking set up to outperform the markets. And then also why it's important to have sell rules. We're in a good period with the broader markets, but there are some groups that are falling behind and are faltering, and then stocks within those groups that are falling apart. These are major recently leading areas of the market that are suffering. So, and you'll see as we go over some examples, really how critical it is to have sell rules in place. Your stocks, there is going to be rotation as the markets progress. We're in the latter parts of a bull market. So the cycles, as far as which areas of the markets outperform, are going to shift. And we are seeing some pretty major shifts right now. And we're going to go ahead and cover that as well. So we do have quite a bit to go through here today. And I'm excited to share all this with you. So let's go ahead and get started. We are going to take a peek at where the markets are now. I talked about how important that is. You want to have the wind behind your sails. And then also we're going to review stocks in groups that have picked up, and making sure that you have alerts to know when that momentum is shifted. So we talked about group rotation. Let's take a quick peek at the S&P. This is as of the close on Friday. And you can see where what I've done is I've overlaid some simple moving averages. From my work, this is critical in analyzing the broader markets. The green line is, we're looking at a daily price chart of SPX, and the green line is a 10-day simple moving average. The red is your 50-day simple moving average. The blue is the 200-day. So overall, we want to make sure that that 50-day remains in an uptrend, your simple moving average. That's going to be your guidepost, so to speak, as far as giving you a sense of a bigger picture, broader market. And we can go back here historically, take a quick peek at that correction that hit us in the beginning of this year. And when we see this 50-day, the red line, start to trend sideways, and then in this case, eventually it did tumble. That is not a sign of health. Generally, you want this 50-day simple moving average to be in an uptrend, and we have that occurring now. And the shorter term, we will get a lot of bounces up and down around that 10-day simple moving average, but it too can be a guide, because even if we go back to this June period where we had a slump in the S&P, this break below was your first warning shot across the bow, so to speak. But once this 10-day starts to decline, that's going to be a little bit troubling, but we're fine here. The 10-day is still in an uptrend, so we have an overall bullish feel to the S&P 500. Now let's go ahead and move on. We of course want to take a look from my work at the NASDAQ, because the NASDAQ is filled with technology stocks, biotechnology, but by and large, this is your growth stock index. And ideally, in a truly bullish phase, you want the NASDAQ to be outpacing the broader markets and performing well. And we certainly did get that for a good portion of the beginning of these markets. And you can see actually in the beginning of this, following the correction is what I was referencing. The NASDAQ came through, really outpaced, a lot of growth stocks in there, technology really forging to a new high. Take a look at this action here recently. We're not in trouble by any means. Your broader uptrend is still very firmly in place, but we are seeing a bit of lackadaisical sideways action in the NASDAQ that is, again, not troubling at this point, but certainly worth noting, so that if you see other action within that NASDAQ starting to deteriorate, you will want to pay attention. But let's go ahead and take a look at the current markets. We want to see where the strength is. So what I've done here is set up the candle glance. This is available on stock charts from that initial account page interface. And I've gone ahead, and in addition to having the broader market indices, I've put in some select sector funds, and this is using the S&P. We have the industrials, and most of the major sectors within the S&P are represented here, as well as some broader ETFs. And what we can do, and I've already gone ahead and added that RSI, that's a relative strength indicator. So the chart durations here are 2 months. You can see that's indicated here, but I've gone ahead and added an RSI to each of these sector graphs, and we've sorted it by descending. So that's going to show us these sectors by strength to weakness. And you may be wondering, why is it important? Well, ideally for your investing, and this is going to be whether it's short-term or longer term, you want to be in these areas that are showing RSI is a relative strength indicator. And as a general rule of thumb, you want to be in those areas of the market that are showing relative strength. They are outpacing not only the broader markets, but their peers. And for those of you that have been following this, you may have noticed how we've been able to pick up on sector rotation. So if we take a look, for instance, XLP is the second strongest of these 12 various sectors. That's the consumer staples strength ETF. And consumer staples about 2 months ago was represented way down here in this lower right quartile. And we've watched the steady progression of consumer staples to the forefront. And had you been astute and following that rotation with us, you would have seen, and we're going to get more into what we're seeing in consumer staples, because the strength there is undeniable, and a lot of the stocks there are reversing downtrends, exhibiting strength, hitting new highs. There's a lot going on, but again, you want to be able to spot that rotation. Let's take a look at with that type of sector rotation, and you can potentially watch this take place here. Let's go ahead and add that RSI. These are going to be different indicators, but what I did want to quickly point out to you here is the fact that the semiconductor grouping that we had listed in the prior display was had been up in the upper left hand. It had been exhibiting quite a bit of strength, and I apologize, that went away. But again, what we were keying in on there is where current strength is relative to the broader markets. It's going to take a little too long for me to dig in, but there are other ways, certainly a lot of other ways that we can go ahead and get in front of where the current strength is in the broader markets. Let's go ahead and take a quick look at, again, that initial page here on stockcharts.com. And this is what I like to do. I'm going to go ahead and taking a look at another way to uncover where the current strength is in the broader markets. This is what's called the sector summary. So again, we are getting a view of those underlying sectors within the S&P 500. What I've done here is sorted the performance, and we're looking at a 1 week. So this is again, a good way to get in front of where the strength is. Here are those consumer staples last week, over the last week, up 3.6%. And so what we can do from here, quite simply, is go ahead and click on to that sector name. It's going to get you to the underlying industry groups. Again, this is over the last week, but pointing you toward where the current strength is in these broader markets. So let's go ahead and take a look. I'm going to go ahead back to this particular area here, and we can dig into a peek at this same sector grouping. This is from July 6th. So I'm uncovering and showing you again that progression and that rotation and how you can capture it by going in. And this really does not take a lot of time. So we're looking at July 6th, that very same 1 week sector performance. And what we can see here is healthcare, again, for that 1 week in the beginning of July, was a top performer, as was consumer staples. This is about the time that this group really started to come into favor. And take a look at technology, still super strong back in that beginning of July period. But what I did want to do is go ahead and take a look at that same view. Actually, this is a 1 month view. So we are looking at the sector performance over the last 4 weeks. And take a look at technology. It really has underperformed. This is that sector rotation that I talked about. We are seeing a bit of a move away from some of these higher faster moving technology stocks, but healthcare really has come into its own. And for those of you that follow stock charts closely, I do have a top advisor corner blog, and I posted there last week outlining each of the reasons why healthcare is outperforming the broader markets. You want to have those underpinnings and understanding of why. It has a lot to do with the fact, first of all, healthcare stocks are defensive. So we are in a period of high volatility. Healthcare stocks can serve you from that point of view. But also, Trump has initiated a lot of policies that are favorable to the healthcare industry as far as pushing drug approval along, funding drug research, and so forth. So in addition to overarching policy reasons, the fact that we are in a period where the markets are getting a bit more defensive, there are a lot of reasons fundamentally. A lot of these stocks are really producing, coming in with super strong earnings and sales over the last reporting period. But let's go ahead. I mentioned that we are still in the throes of earnings season. So what I want to do is take a look at some of these stocks that are going to be reporting earnings this week. And we are in the latter stages of earnings, and this is a period when a number of retail and consumer related stocks are going to be reporting this week. So let's take a look at just one. We're going to be taking a look at several, but the first of these stocks, this is Ross Stores, ROST. Their earnings are due on Wednesday. And the retail consumer space in the broader markets has been super strong. this year, certainly. And what I did want to point out to you with Ross Stores is the fact I talked about there being some hints that these companies could very well come in with earnings that are ahead of estimates. And one of those is if you see analysts revising earnings estimates higher. And in fact, with Ross Stores, that is the case as we are going into earnings. Analysts are revising their estimates for this year higher. And then also, it really helps to take a look at how how the stock did the last time that they came in and reported earnings. And this company, Ross Stores, did in fact have a positive response to their earnings, and they have trended higher subsequent to that. So the company is on deck for a 28% improvement in their 2018 earnings versus last year. So I did want to point out Ross as a stock to pay attention, put it on your radar screen. Their RSI is in positive territory, as is their MACD. And it's always quite helpful to take a look at other stocks within their industry group. So Ross Stores is a retail discounter, apparel. So there are other stocks that have reported that we can just take a quick peek. This is a stock that we've favored. I have a biweekly newsletter, the MEDGE report, and this is a stock that we picked up prior to their gap up on earnings here. But Five Below is an apparel retailer, not quite the same as Ross, but certainly a discounter. And we can see that this particular stock came in with earnings, gapped up, and is continuing in its uptrend. We're seeing a lot of that with these earnings that gap up. So another retailer that is reporting this week is Kohl's Stores. And for those of you that follow the market super closely, you may have noticed that other big box retailers reported last week, but we'll get into that in just a minute. Let's take a look. I talked about reviewing prior earnings reports as a guide. And we can see that Kohl's did, in fact, have a very strong earnings report here most recently. The stock trended up and has remained in this general uptrend. So Kohl's is due to report tomorrow. This is another stock where the earnings estimates are being revised upward as we go into earnings. So I mentioned that would generally is a positive. Let's go ahead and take a look at another large mall retailer that reported last week. And this is Nordstrom. And so Nordstrom came out with earnings last week, and we can see where the stock gapped up, and it's up another almost 3% today. So we like to see that type of gap up on earnings, but generally Nordstrom was also trading in a constructive fashion going into earnings. So I will tell you, of these big retailers, Nordstrom and Kohl's are your bigger winners, if you will. They have strong positive earnings estimates for this year as well as next. That is going to contrast to a stock such as Macy's that was down as much as 16% on earnings last week. But this is a different story. Macy's does not have strong earnings estimates. It's not as strong a company. So I would tell you that Kohl's certainly looks to be in a better position going into earnings. Let's take a look at another stock that is due to report later this week, and that is HPQ, formerly Hewlett-Packard. And the reason, I know I mentioned that technology overall is not doing as well as it has been, but I will tell you HPQ is more of a retail consumer play. And as a backdrop, we are in a period here where unemployment is at a well over 20-year low. We are seeing wage increases, consumer confidence at an 18-year high. And so consumers really are opening their wallets, and that's been the big driver here in the markets, with consumer retailers, discretionary stocks doing quite well. And it's even a driver in the move into consumer staples. A lot of those stocks that are doing well are being driven by sales from consumers. But let's get back to HPQ. Take a look at how constructive this stock is, in the sense that it is on Friday. It broke out of a 2-month base. And this is a lot of my work where I'm looking at stocks that are emerging out of patterns, and it did so on very big volume going into earnings. It's another company where estimates are being revised upward. And what I wanted to point out to you here as well is, let's take a look at, there are two other stocks that are in this. Hewlett Packard does, among many other things, but their primary driver of sales is the uh, revenues that are derived from sales of laptops. And we are seeing a big pickup in sales of these laptop computers. And we can take a look at LNVGG. This is a company that is Lenovo. Actually, that is not, but I have another one that we can take a look at, and that is Dell Technologies. This is their earnings. They gapped up. I would take a look at Lenovo. That's another one that gapped up. We're seeing a big pickup in these the sales of these laptop computers. And the reason is because the processing is getting even faster. They're developing a lot in the way of cutting edge technology. Gaming is a huge part of the industry. So as these computers get faster, get more powerful, they are being picked up. So what we can take a look at here is, let's go back to HPQ, because I talked about the fact that that stock is acting really quite constructively going into earnings. Your RSI is positive. Your MACD is certainly positive. And I wanted to point out how it came to light to me that these laptop computers are really having robust sales. And that was 2 weeks ago. AMD, which is a large semiconductor chip manufacturer, they had a huge earnings here. They gapped up. And again, the primary driver here for them was the sales of these processors and chips to these laptop manufacturers, because sales have picked up. So I would put HPQ on your radar screen as we go into earnings. And we can have time here to take a look at, I'd mentioned to you the strength in consumer staple stocks. So I wanted to go ahead and show you a graph of that sector. It's XLP is the ticker symbol. And we can see, I'm going to go ahead and pull up a weekly chart. And what I wanted to point out to you is this downtrend reversal that has really picked up here on these staple stocks. So ideally, again, keying in on these moving averages, you want the price to break back above these simple moving averages. Your RSI is trending positively. So we can see that this downtrend reversal is really taking hold in consumer staples. But really, more importantly for this earnings period is the fact that because these consumer staple stocks have generally underperformed certainly other areas of the market, a lot of these stocks are being viewed as having valuations that are more palatable than the technology and some of the other stocks that have really done well. So that is putting these staples stocks in a pretty good position as they go into earnings. Let's take a look at some of the companies that have reported. This is Clorox, CLX, and we can see this big gap up here on earnings as the stock, similar to the group, is outperforming. And this is an example of the consumer. Clorox has gone into producing products that are designed for pet owners, and that is a huge part of consumer spending, certainly for pet owners. So Clorox, and we can take a look certainly at other names in consumer staples that have really begun reversing these downtrends. And each one of them have developed new product lines. Another big driver here, and this is important when looking at stocks, is an increase in pricing. So this is Kimberly-Clark. They announced last week that they are going to be increasing pricing across the board with their products. They have products such as Charming, and so forth. Clorox also announced increased pricing as well. So that's going to be a driver going forward for these stocks. But let's take a look at a company that is going to be reporting. There are two that are in the consumer staples space. The first one is Hormel Foods. And I have to tell you, quite frankly, normally these are not the types of stocks that I would be attracted to. A lot of these do only have single digit growth prospects going forward. But there is, as I said, a rotation into this group, an appetite for these stocks. And more than the fact that they are coming in with earnings and sales is that defensive, the move into some of these more defensive stocks. Hormel Foods has a 2.7% yield. That's another factor, as treasury yields are really kind of remaining a bit stagnant. So Hormel Foods, what I wanted to point out to you with that is earnings estimates being revised upward. So you're going to see a theme here. But Hormel actually is on track for 18% growth this year. So that's a bit more than some of those other larger names that I mentioned. And I apologize. Actually, the yield on this is 1.9%. So we will take a look at another one that has a bigger yield. But what I wanted to point out to you here is the fact that Hormel Foods, which has primarily been known for meat products, porks, and so forth, they are moving away from that industry. They're getting into other areas that have higher growth. We are seeing a trend away from not universal, but certainly a move away from meat eating, so to speak. But Hormel Foods has gone, they have other brands that they've embarked upon, peanut butter, muscle milk, and so forth, fruit bites. But the bigger point is that they have gone ahead and broadened out their offerings to go ahead and reach a broader audience. So this company is going to be reporting. And then one last one is SJM. This is the company that has a 3% yield. This is JM Smucker. And again, this is more of a single digit grower, not quite up to my par, but it is attempting to reverse. It's not attractive to me at this point yet. We're still below key simple moving averages, but we are getting a sense that it's trying to reverse. So for those of you that are comfortable playing that type of stock, I would put that one on your radar screen. And we are running a bit out of time. I wanted to spend 1 minute on being sure and making sure that you have a sell system in place, because within technology, for instance, semiconductor stocks have broken key support. They're trending downward. A lot of reasons for that. But more importantly, what I want to do is take a look at an example of a semiconductor stock. This is Applied Material, AMAT. This is a weekly price chart. So when you see these stocks break below key simple moving averages, this is a weekly. So we have a 10-week or 50-day, 40-week, 40-week or 200-day. So when the stock price breaks below these simple moving averages on volume, and you combine that with an RSI that is trending negatively, as well as a MACD, you absolutely want to be aware of that. So most importantly for me is to inform you on the characteristics to look for when that uptrend has reversed. This is going to be important for you to put alerts. So I mentioned to you earlier that semiconductors have faltered. We are seeing a rotation into other areas. So if you have a stock such as large semiconductor that breaks key support, your RSI and your MACD trend negatively, you want to exit that stock because the prognosis quite clearly has potentially changed. And here's another example. This is Lam Research, LRCX. I will have to leave it at that, but this is a weekly price chart, same phenom, breaks key support, and your RSI and your MACD are trending negatively. And that's it. Good trading, everyone, for this week.